And we are off. Welcome everyone. My name is Glenn Thompson. As you see on the screen, I've been working as a mentor for almost 16 years now with Pacific Trading Academy, and happy to do so, and happy to be here. We are recording today's presentation, so if you miss any part or if you'd like to review, you can access the website as you see, www.pacifictradingacademy.com. We archive all of the presentations that I do as well as my coworker mentors. So good to have you here today. Let me move the presentation. Oh, 1 second. Okay, today's title is Let Bonds Lead the Way, where I'm going to present some of my analysis of what I pretend for the economy at large and some of the major capital market sectors, and in particular with a focus on the Treasury and bond market as a guide or as an instrument that I can use to shed some light in various capital sectors and some corresponding trade scenarios. So if you have questions, I pretty much would request that you hold them till the end. I know that there will be ample time to address the questions. It's good to be with you again. I haven't talked to you since I think last November. Typically I do a presentation maybe once a couple of months, but had a little longer delay. Yeah, someone's okay. Before I go any further, someone does not have a visual. Let's see, Pete. Let me double check before I move any further. Anyone else not seeing the screen? Because that will be an important component of, you know, they used to say a picture's worth 1,000 words with whatever degree. All is good, okay, because it's worth right now about 200 words, given inflation and the declining premium of graphics. Anyway, thank you. Hope that was just a temporary and singular situation. So hopefully we've got it ironed out. So let bonds lead the way. So in particular, we want to start with an insight to how I do my research and what how I achieve and derive the conclusions I reach. I am a technician. I would say 97% of my analysis starts with the chart. And as a subset of that, I place a particular premium on market timing. Timing should always take precedence over price. I work from the vantage point or perspective that a market's going to do trend-wise and price-wise whatever it does, but from a causative standpoint, I believe that the price fluctuations we see from the smallest to the largest and all type of market changes and dispersions are a functional consequence of certain specific time periods having occurred or elapsed or ticked off the clock. So timing is of critical importance to me. I realize that's a minority of technicians or analysts place as much emphasis as on time that I do, but I've gotten good results from it in the 34 years that I've been in the business. Money flows towards greatest rates of return. So certainly if we're talking about the economy at large and the interest rate and bond sector in particular, I want to concern myself with money flows. Money always looks towards for the greatest return that it can. So we often see capital flows reflecting optimal, or at least an intent to seek optimal returns from a fundamental perspective. I just mentioned that I'm primarily a technician. Certainly when you're talking about interest rates, it's so directly related to things in our economy. So I do want to have kind of a brief preview that's bordering and centrally reflecting fundamental components of our economy. That's why. This is just a slide indicating certain specified kind of well-embedded intermarket connections in our economy, the dollar, commodity, and how the bonds and stock sectors typically react given certain changes in major aspects of our economy. If rising dollar, falling commodities, especially things like oil, bonds tend to rise, stocks tend to rise as well. If you have the opposite relationship, then you see the corresponding correlations in their end results. And then these, of course, are modified during periods of deflation or inflation where you see sometimes a decoupling between the bond, equity, and debt sector. But this is just more to kind of give you some background in terms of what I do. No slider, VJ, no slider chart. All right, let me just make, let's see. No, you're not seeing, okay. Let me, before I progress, because I was just about to get into the charts, so I want to, this is problematic. Hold on, let me see. Speakers seem to be good. You have the audio? Hold on, let me click. What about now? Audio is fine. What about visual? Do we have a visual? Okay. Sorry about that, folks. Okay, good. Thank you for the response and appreciate it, because yeah. Thank you so much. All right, let's proceed. If there are any further technical issues, please just indicate it, because I kind of will intermittently be scanning to see the feedback, because no point in progressing the slideshow without it. All right, so these are just a visual of some of the standard kind of inner market connections that fundamentally I think about as a backdrop to the technical work that I do. Of course, I could take this another segment back, what are the drivers and components and factors and parameters that influence the US dollar or any currency, and it would be those factors more deeply embedded in an economy, government spending, consumer spending, tax, monetary policy, etc., exports, import differences, etc. And then there are intimate feedback loops. It gets so complicated. Part of the reason I wanted to incorporate this slide is it's part of the reason why I primarily start from the technical, from the chart of the sector I'm interested in or the instrument I'm interested in, and then try and figure it out and see where possible alignments may occur with events that are occurring in our economy. This just gets unduly complicated. The nonlinear relationships and the inexorable complexities that often arise based on some of these standard intermarket correlations and connections get almost impossible to figure out sometimes. So under normal conditions, much less stressor when there's stressors in an economy. All right. So nevertheless, let's move to the charts. If I can, let's say. All right. Progressing. All right. The big picture. This is a long-term 25-year picture of the standard treasury, the 30-year treasury bond, not the interest rate. So we're looking at nominal prices of bonds here. One of the things I look at, and those of you who've heard presentations in the past know that I do use Elliott principle. It's not the only. I've mentioned. I say that to students sometimes, and I've heard people respond and say, "Well, Glenn is an Elliottician, and that's all he does." Certainly, that's not the case. It's simply one of the tools. I think it's a very fine, though not perfect, descriptive tool to help me assess plausible scenarios for why a market's doing what it's doing. And to the extent, often it will sometimes give me or put me in the ballpark in terms of some possible reasons as to why the market's where it's trading, what a given market's where it's trading. I use it. When it's less clear and more ambiguous, I put it on the shelf and look to other models to give guidance in terms of how to interpret the current price and project and make projections. But you can see I've got, for those of you familiar with the Elliott principle, you kind of understand what we see here. If you don't worry, just suffice it to say, in a broad sense, markets move in waves. The basic premise of the Elliott model is that there are two major phases or components constituting what's called an Elliott wave cycle. One is the initial set, the first set is called the bull phase, and there's a bear phase. The bull phase consists of 5 waves followed by a 3-wave or 3 configured wave bear market. So I think that for the last 25 years or so, we've seen rising treasury bonds moving up. As you see, we're almost parabolic, and we're bringing this over here to the current month. Again, this is a monthly chart, so each vertical bar represents a month going back, as I said, 25 years. It's hard to see It's not too important and critical a point, so I didn't blow it up, but you can, a subsequent slide will show in more detail and you'll be able to visually observe it. But down here, this stuff down here, these lines, the red line are commercials. This is the COT report graphically indicated. What's important now, and you can see this red line kind of going back a few years. I see my years kind of got chopped off here. That didn't occur when I was going over this last night. Anyway, yeah, you can see the red line has been decreasing such that it's net. These represent net positioning on the part net positions overall by different important sectors: the commercials, the small specs, the large specs. But you can see you've had a definitive decline from moving from the positive net long to net short over. That's going back, let's see, that's about 16, 15, 14, 13, about 2012, 2013. For the last 3 to 4 years at least, you can see this definitive change in the net positioning on the part of the primary sector that occupies and is responsible for about 70 to 80% of volume in all markets most of the time. And you can see that's very bearish. That's why I have that in there. Why I've included it, even though you can't see it there at the very end. And we have a kind of a mirror image position on the part of the small specs, which renders that even more significant. I'll come back to that, but the primary purpose for this slide is to show you the long-term trend in bond prices, as you see, and we are at a point that I believe corresponds with a terminal point, and why I'm bearish the bond market. Okay. And then we can move from there. I am bearish on the nominal price of bonds, and so we can infer what my expectations in terms of rates are in the yield curve and so forth, and kind of integrate that with what we're seeing day to day, moment by moment in the economy and corresponding instruments. Someone has a comment or a question. Let me just see if it integrates. The problem in the bonds is that wave 4 penetrates wave 2, so this count is invalid. Well, I understand if you are, that would tell me you haven't been up on the most recent research in the last. When I say recent, let me put that in perspective. You have a good point. That is one of the rules. There are 3 rules in Elliott. The end of 2 shouldn't penetrate the start of 1. The end of 4, and this is vis-a-vis what your point is. So let me speak to it right away because I don't want other observers or subscribers to have any issues here. There is, in Elliott's original papers, 1939, 1940, he stated the end of the 4th should not overlap, no part of wave 4 should overlap any part of the first wave. And that was the original principle. If you are familiar with more recent research by Prechter, by Richard Swinell, by Robert Kennedy, by Mr. Hennessy, we noticed over the last 50 years or so exceptions to this, most definitively in the Forex and in currency sector in particular. So we made special cases. I would submit to you, do some research on RTB, retrending B waves, and so I no longer place as much emphasis on it. I certainly know the rule to which you speak, but it is no longer as I would say I take a soft view of it. I'm being conciliatory towards your point, but you have the correct, based on Elliott's view. Elliott didn't have, and back in the 30s and 40s, they didn't have the technology that allowed. He saw a number of the exceptions to which I'm referring, and why over the last 30 years in particular, many Elliottians have eliminated or kind of jettisoned that particular restriction or criteria. So that's why. Otherwise, but I certainly know, I didn't want you to think I'm taking liberties with a model. Anyway, I no longer use it. That's why. So and it's based on a generalization of the model that a net effect is we're able to tighten up our wave counts. But it's called RTB wave. If you want to do a vetting or a searching, check out RTB. I can't think of the primary researcher's name, but his last name is Hennessy, and that's why you see that there. And then so I think all this action here is your 5th wave. The reason that's important is the primary utility of Elliott is to enable the practitioner and the analyst and observer and potentially trader to project or to know, in fact, when a 5th wave has been achieved. the primary utility is such that to the extent you are confident a fifth wave, market's at a fifth wave, the market must reverse. That's the terminal point. So that's the whole practical point of Elliott. From a trading standpoint, if I have, now the catch is, the million-dollar question is, to what extent and what factors are you looking at that can give you whatever degree of confidence in the reliability of your projection that in fact a market's at a point in its time price trajectory that is coincident with the ending of a fifth. But to the extent you are confident or know in fact that the fifth has ended, the market must reverse. There are no exceptions to that. So that I believe we're there. I wouldn't say I have perfect certainty of that, but I would say 90% confidence that in fact we are either at or nearly arriving at, in a limit kind of sense, the nearing of a number of five waves, and I'll get into that in more detail. Because Elliott also indicated when you have at least 5 nested fifth waves, or 5 degrees of fifth waves embedded one within another, you have about 97% confidence that the market will turn, and I believe we have more than that. So that's why I have confidence in my bearish view. So this is the bigger picture, but good point, whoever pointed out the fact that the fourth wave penetrates wave 2. I'm aware of that, but in relative to an adjusted view that has primarily many Elliotticians, not all, but many, myself included, I no longer am sensitive to that restriction. It's not that I was just taking liberties with the principle. All right, next slide if I can. Okay. This is the weekly chart, just showing a little more, coming in a little more depth. So you can see this would be, let me try and correlate these two. This 3 here, the end of the third and then the fourth are the same, but I'm going to drill down in time from the monthly to the weekly, and then we'll see in subsequent slides the daily and so forth. But this is from point 3, the same point 3 and point 4. Well, if this is wave 4 that you see began in 2014, everything through where we are today, at yesterday's close, would be a particular fifth wave. One of the tenets, structural features, or attributes implicit in the model is that all odd waves, all impulses, should subdivide into 5 smaller waves. It is the fractal or self-similarity component so essential. It's a foundational concept intrinsic to the Elliott model. So we want to take that into account. So if everything from in this space, this segment of the price history, starting in 2014 bottom here, what I believe is the end of a particular fourth wave, it is by definition the start of a similar degree or scale or fifth wave up to where I think we are right now, currently. And this is just a weekly chart of the sun. Here you can see, down here is the same report that we saw on the previous slide, but it's a little better. I think you're able to more readily observe it visually. And what's important is notice the red line here. It's again from early 2013. You can see overall a general trend in terms of the net positioning by the commercials, where they started out net long and they are currently, as of present, net short. You can see they're by their current level on the vertical axis of scale, somewhere between, about 2,005, or what is that, 25,000 net short positions. What's of special importance, and in and of itself, that's bearish. Why I thought this was noteworthy to visually demonstrate is rarely, 15 to 20% of the time, do you have the blue line, which is the small traders, that's you and me or any trader that on average is not doing at least 100 lots or 100 contracts per order, per size. So anything, the green line are the large institutional or large traders. They're on average, their trade sizes larger than 100 units per entry. So normally you have the large institutional traders, or large specs as they're referred to, illustrated in this picture by the green line, mirror image or opposite, same number, but absolute value the same, but opposite sign to the commercial. That's 80–85% of the time. That's the normal status quo. Every now and then you have a very rare or relatively rare scenario where you have the small traders oppositely positioned to the commercials, and we have that now. The logic of this is that 80 to 90% of the time the small traders get it wrong. So if they are polar opposite in terms of their positioning to the commercials, and they're wrong most of the time, that lends added credence to whatever it is that the commercial trend in terms of the net positioning is. So I find that especially bearish at the moment as a potential leading indicator. Typically there's a lag, and this is where one of the question marks in terms of attempting to integrate a commitment of traders or a COT study into your analysis. The question is, or one of the questions, material and relevant, is what is the magnitude, what's the duration of the lag time? So that's where there's some variability there. I don't know. It depends, and there are a lot of variables and factors that would impact and determine what that is. And to the extent the COT data itself doesn't specify what that lag time is, or what's the amount by which the commercial positioning is leading the price, you have to, or necessarily by default, I look for other models and other relationships to more finely clue me in on that. But at least in a qualitative sense, we understand most of the time, whatever it is that that commercial trend trajectory in terms of their net positioning is, serves as a preview of what we can expect the price to do. So they are, so the bottom line qualitatively, on the one hand, we've got this current nominal net short position, about 25,000 or so net short by the commercials in the bond market. But more especially, what's of special interest at this juncture is the idea that simultaneous, very atypically, we find that the small traders are closer to exhibiting a mirror image than what is normal, and that really adds more intensity to the positioning and pathway and behavior of what we're seeing in the commercials. So it makes it more bearish than it might otherwise be if simply the commercials were net short. All right. Okay, so this is a daily chart of the 30-year. This is the March front month, the March ZB contract, and just showing a little. I wanted to give a little more detail for those of you who are inclined and want to get and like the Elliott principle. Let me just see. Why are there gaps on my chart? I don't know. Oh, you mean back out here? Because I'll come back to it. It's a technical question. This has to do with at that time back, the gapping and the sketchiness has to do with the lower liquidity. At that time, if you go back, this was not the front month, so that's a vestige of a technical of a logistical feature intrinsic to the futures markets. Unlike in the stock sector, there are no termination or expiration points. At that point in time, if you go back last summer, we were trading in in another contract, and so this contract, though it was trading, was very illiquid, creating the spaces and the sketchiness you see. It's a vestige again of a feature peculiar to the futures markets, which is atypical if you're probably the person who's asking that maybe is an equities trader, and that you don't have a similar phenomena or a counterpart there. But that's neither here nor there. Don't worry about that. If it is a question, I'll come back to that if you have further questions on that. Someone's asking, when did I get bearish on bonds? Well, through the confluence of all the factors, one of which, again, or two of which we've just addressed. So one is I'm building a case here from my Elliott to show you that I believe that this top that came in on February 11 corresponds to the end of a fifth wave. To the extent at whatever point to your question, I felt that in fact had, I'm accumulating or acquiring a preponderance of evidence more strongly suggesting that in fact this high here, which is this day right here, is the top on this chart, is February 11. To the extent I believe that that is the end of a particular fifth wave is one factor as to why I got bearish. Why? Well, one of the tenets of the Elliott principle, it's just one reason, not the only. Rarely do you want to make any trading decision, much less establish a position put money on the line in a position on one singular fact. But that is simply one component, one relationship that has a high correlation with reversal or change in the behavior of a capital freely traded market. The other is the relationship, as the previous 3 slides indicated, where I was observing and cognizant of changes in the relationship of the 3 primary components or constituents of the market, i.e. the commercials, the small traders in particular, The relationship between commercials and small specs, as they're referred to by the government, the CFTC, is particularly noteworthy, because when it normally they are very often you'll find the small traders moving in sync with the commercials, and that means they're losing money, because remember, there's a phase separation, or the market and the commercial position, their pathway, their behavior, etc., tends to be out of phase, which means that the commercials are often 80% or so or more of the time moving in a direction opposite or contrary or out of alignment with the trend of the price. So if you are in the market at any given juncture and your attempt is to profit, you have to be one way or the other, unless you're in an option play of some sort, attempting to exploit a certain volatility discrepancy. You must be in sync with the trend. There's no way, at the end of the day, the trend is the ultimate definer of your success in this business, by definition. I don't care. You could have 10 things that tell you a market's going to go one way or the other, and if you, for whatever reason, are not positioned similarly, you either have a problem at that very instant in time, or I guarantee you will shortly. That's the point of rubber meeting the road. So to the extent that very often we find commercial trend and their nominal actual position at any given instant in time opposite the motion and behavior and level of price, is the extent to, and to the extent the small traders are similarly positioned, is the extent to which they are not likely to generate a return, but instead incur debit or loss. That's why they're, as I said, they often 80 to 90% of the time get it wrong. But remember, maybe a critical, a point I failed to make explicit, and that is, commercials are not in the market for, ostensibly, in a theoretical sense, for profit. They're there for a price hedging mechanism. So they can weather extreme counter moves relative to their position. That's secondary to their reason for establishing hedges in the first place. And that's why they have staying power, and that's why whatever they do has ramifications for the future in terms of the actual market. Is what the market does. They move the market. They become a primary fundamental, if you will. So that's my long-winded explanation. Whoever was asking why or when did I become get bearish on the bonds, well, number one, shortly after February 11, because to the extent at that point the question I was asking myself and conjecturing, to what extent do I feel I have sufficient evidence to believe that this top that came in on Feb 11 will mark the end of a particular fifth wave. At whatever point I have enough evidence, that would be one factor. So in and around shortly, just a couple of weeks ago, yeah, is the quick answer. But also watching the trends for the last few weeks and months in particular, specifically related to commercial activity and its interaction with the other two constituents, the small specs in particular. Yeah, it's typically in response to an accumulation of different ideas. Okay, very good. So what I wanted to actually, for those of you who are Elliott adherents, I wanted to show you a little more objectively why I have a particular count that I do, or wave description. The reason, if you see, I ended this wave 3 here. This is wave 1, this is from the bottom here on November. I believe that was November 9. Yeah, November 9. This bottom. This is one of the internal set of waves. One. Remember, each odd wave, and so we're talking about fifth waves, as a tenet of the model, should subdivide into 5 little waves or internals. So I believe that if this move up from the bottom on November 1st through the top here is 1, correction 2, right here as you see, as I've labeled, where I had a number of trades. This could be 3, any of the tops. This could be 3. It could be. I could be wrong. In other words, this could be 3. This could be a part of the end of 4 or a part of 4. I'm not saying. Remember, I said I have about 95, 97% confidence that the top that came in on the 11th of this month is in fact the end of a fifth. But I could be wrong. There's maybe 3 to 5% chance, based on everything I'm looking at, that this is the 3. In which case, this could be a correction and there's higher prices to come, unless we have what's called a truncated fifth. But I don't think so in the scheme of things, given other evidence that I'm looking at. But based on just in a vacuum, if we're just looking at isolation at the model and most plausible probable wave descriptions, or counts as we refer to them, I do have, like I said, over 90% confidence that the top that came in on Feb 11 corresponds to the end of a particular fifth wave. And as such, that's a large factor in my that enables me to have confidence in my bearish view of nominal bond prices. All right. Part of the reason for this, it's not definitive by any means. I certainly don't want you to think I am saying this is a guarantee. I'm trying to illustrate and present some of the more technical, analytical components, that any one of which by itself is woefully insufficient to really feel strongly about an argument for a particular view or projection, but in aggregate tends to take on stronger, suggest a higher probability of acceptance. So I think this is a 3 because it's a Fibonacci extension. If you see, this is what I have chosen, this top right here, to mark the end of a particular internal third wave, versus the lower top, like such as here, or the February 11 top that I believe corresponds with a fifth. Why? It's the closest top corresponding to a 1.618 extension of what I call wave 1. So those of you who, that's just an internal embedded Fibonacci ratio proportion, one of the peculiar to third waves. It doesn't have to be the case, nowhere is it written, but it's often the case. So I find that all things being equal, if I have a selection of a choice of selections as to where I might end a wave 3, all things being considered, or isolated other variables for the moment, I would more likely have a bias of selection preference for picking the area that would most closely correspond to that Fibonacci tendency of formation. Okay, so that's why ended wave 3 there. This would be 4, I didn't put that in, and this would be the fifth. All right, so this is the daily indicating some explanation to my wave count as observed on that scale. Next slide. Let's see. Okay, little more detail. Now I mentioned this a few minutes ago. One of the maybe, I don't know if it's well known, but one of the features when I went back many years ago when I was in my 20s attempting to teach myself Elliott wave, it was very frustrating, very challenging for me, but over time the light got brighter and brighter. It started very, very non-existent and progressively moved from stages of dimness to greater and greater degrees of brightness. Not by any means suggesting I'm all the way there, though. It's a progressive endeavor, certainly. But one of the beautiful features of wave analysis that I learned many years ago that Elliott, through research and statistical testing, came to is that one of the, again, the central question is, or utility of the model is, to the extent that you can determine that in fact a market's at a point in price, and I should say price, I inadvertently said price time, and Elliott is primarily focused on price. I mentioned my thought as to the importance of timing and analysis, and overall from a cause and effect standpoint, I believe time is the causative factor responsible for all price fluctuation. And I know that is not a generally held view. I know I'm in the minority. That's a W.D. Gann view. So that's a completely different universe of analysis vis-a-vis the stuff I'm referring to, the Elliott idea. Elliott, though, is I would say 90% focused on price. So this is why I do it. I want to have, purposely, I want to juxtapose and for purposes of comparison and relative weighing the values of very different models and concepts and relationships to see if however improbable it is, however infrequent I might expect, given different sensitivities and different internal design and as such different ways by which I would expect certain reactions to occur between market behavior and motion and affairs, and how different models that have been designed completely differently would expect when different things tend to converge or cluster or align. That tends to suggest statistically the odds are that I'm at least on the right track. So this is why purposefully I want to create methodology based on a constituent soup that is constructed from individual ingredients that are quite different from the ground up, so to speak. So again, coming back, one of the points that Elliot realized that if the utility of the model at its best when it works is to enable the practitioner to with greater edge and confidence identify the end of a fifth, and as such the turning point or terminus point of a market. Anything and everything that we can do that would serve to provide evidence that in fact that market's at that fifth wave. So one of the things he found statistically that I found quite impressive is this idea of embeddings or nestings. And specifically, he said when you find or can locate, and you won't always see this, but if and when you do, to the extent you observe that there are 5 levels of fifth waves that are nested or embedded one within another, that tends to correlate 97% of the time. 97% of the time when you have a fifth within a fifth within a fifth within a fifth within a fifth. I just counted out on my hand, my 5 fingers. A given fifth wave within a larger degree or scale fifth wave within a still larger, within a still larger, within a still larger. Now, you won't always find that. In fact, I would submit more often than not, you don't find that. When you do, his evidence and his research indicates statistically that will correlate with a 97% reliability the market will turn at that juncture. By the way, that's not saying that a market cannot turn minus that level or that degree or number of fifth wave embeddings. It's simply saying to the extent you are in observance of that many fifth waves embedded one within another or nested one within another, that will let you know, got a very good shot. 97% of the time the market will turn. And I believe I have identified at least that here. So this is these little lines that I put on. I admit, I was up I had major problems putting this little PowerPoint last night together, so it's not quite as clear. And normally I have our computer department assist me and do a bang-up job on this, so I apologize for the lack of visual resolution. But suffice to say, this is from this bottom. This is the daily front month, the March ZB or T-bond 30-year Treasury contract. So I wanted to graphically illustrate. Again, remember, here's the operating principle for those of you who are completely ignorant or unaware of the model, or those of you who maybe this is new to, even if you have some knowledge of the Elliott model. I wanted to give you at least a little more of an explicit breakdown as to the concept, because it can be powerful and it is a helpful relationship to seize upon to guide us in terms of determining when in fact a market might be at this critical terminal point. Okay, so but it starts from this premise. You've got to first be cognizant of the idea that all odd waves, and certainly a fifth wave is an odd wave, all impulsive structures in a market, that would be wave 1, wave 3, wave 5, wave letter A, and wave letter C on the bear phase. In the bull phase, remember, 2 subcategories of a Elliott wave cycle, basic Elliott wave theory 101. You got the bull phase, you got the bear phase, all of which together constitutes one Elliott wave cycle. The bull phase consists of 5 waves, 1, 2, 3, 4, 5. The bear phase consists of 3 waves, by convention labeled letter A, B, C. 1, 2, 3, 4, 5, ABC, creating one complete Elliott wave cycle, the end of which completes that cycle. What serves to further propagate a market forward through time is a new cycle begins ad infinitum, and this is what keeps the markets moving. At least that is Elliott's idea. It is a model that he created, which is merely a collection of ideas that he surmised through his research, could be a plausible set of relationships that serves as a catalyst to trigger and perpetuate and propagate market motion with time ticking off the clock. Is it perfect? No, it's merely a collection of ideas. Often it's more correct than, sometimes it's more correct than at other times we see significant excursions away from what the real world is doing. But we recognize it as such, we put it in that context, and I in particular incorporate it and put it in the context with other specifically things that are quite different, very and juxtaposed. And when I get, however infrequent it is, points or nexuses where they tend to get into alignment or agreement, that suggests to me I have a higher probability of appreciable of relationship or correlation that might be greater, have a higher intrinsic trustworthiness. Okay, so coming back to this, this is the idea. If this bottom here on January 22nd is observed, this is a daily chart, so we're on that scale. And the different degrees, by the way, typically are a consequence or a function of certain time periods. You know, you've got when Elliot came out with his papers in 1939, 1940, he indicated and designated and identified 9 primary degrees based on, depending on who you talk to, Prechter, Swinell, Robert Kennedy, whoever, any of the known guru Elliotticians out there. Today there are between 15 and 16. If you are a very super high frequency day trader, we go down to, like, you know, seconds on one extreme. I think it's called the nano. I forgot. I rarely do I utilize Elliott on a level of 60 seconds. You can, though. And merely it is time universally more or less agreed upon time periods that tend to define and distinguish and differentiate one degree of structure or scale versus another. Up to the super cycle or grand whatever super cycle might be 25,000 years or something. And so usually my time horizon for being in a trade from a position trading standpoint or swing trading standpoint may not, I'm not in a position unless it's some long hedged bond or not a bond, but a option spread of some sort where I'm volatility hedging or something. But barring that, usually it's 3 to 6 months, you know, window. So I'm typically looking at what I refer to as the what is it? The minor. I look at the minor degree. Actually, this is something I learned years ago, and I always forget the degree designations. But it's, again, the point here is that they are based primarily on time, and I look at what I call the primary, which is usually about 4 years, kind of closely correlated with the 4-year presidential cycle. Primary is plus, in other words, the bull phase would take place, or the entire set of 8 waves, roughly on plus or minus about 4 years. Above that is what we call the cycle degree. Below that is intermediate, and then below that is minor. So the primary degree is kind of what I have a window on plus or minus about 4 years. So what that means is that you would fit a set of 8 waves into a runtime of about 8 years, plus or minus. Okay, so we're at the degree here where, and it's not always on average, you might say you would space it out, divide the 8 into about 4 years, but it's not that way because different waves, like for example, fourth waves tend to take inordinate amounts of time off the clock. So it's not as perfectly distributed as that. But nevertheless, the entirety of an 8-wave cycle for what I call the primary degree tends to be roughly about 4 years or so. All right, so and the minor would be a shorter period. The cycle, which is the next level or degree higher, would be, I think it's like, I don't know, 15 to 25 years or something. Anyway, okay, so this is if this move from this bottom on January 22nd through the top here, February 11, is a particular 5th wave, which I believe it is, then there should be 5 internals within it. And if you can see, this is the 1, the 2 I've marked off graphically with simple trend lines, if you will. The internal 5s based on, I see structure that is consistent with that internal, the number of inflections consistent with the peculiar attribute typical of the model. Okay, so everything from, here's my theory or my count, as it were. Everything from the bottom on January 22nd through the top, February 11, is a particular 5th wave. Well, if it is, by the way, folks, you would want to maybe, let's see, if I can relate this to this activity, the longer term view. If I want to, this is everything from back here, the start of 2014 is everything from that bottom, beginning of 2014 through where we are, let's say yesterday or right now, is a particular 5th wave. It's of a larger scale, size, level of observation, magnitude, what the model term, we use the terminology degree to indicate the scale. Okay, but if everything, I should have drawn a straight line connecting this bottom here to this top to graphically illustrate my belief, my view that that is in fact a particular 5th wave of a given degree. If it is, if I'm correct in that assessment, then there should be 5 internal divisions within that space, in that segment of time, according to theory, according to the principle, all right? And I believe you can make a case for that. I didn't mark them here. This could be 1 right here, this little top, if you see my mouse. This could be 2. This area in here, either this or this, these areas would be viable candidates for where you might want to mark the end of wave 3. I'm going to mark it right here, 3, and this is, or 3 might be, or 3 here. This is your A, B, C, and then this is, yeah, and this is the 4, and this is the same bottom. This is November. This bottom here would be this is A. This move from this, let's assume that I'm going to call this 3 for reasons that I don't want to take time to go into, but it is referring to the RTB wave I alluded to a few minutes ago in response to one of the viewers' questions about why I had a 4th wave that encroached on wave the end of wave 1 territory. Okay, because of this RTB phenomena where the B wave of the 4th of a larger move encroaches or breaks out into new price territory. That's the basic promulgating idea. So if this is the end of 3 right at this point, this could be your A, this is the RTB, this is your C of the larger 4th, corresponding to the end of the 4th wave of the entire 5th. Okay, if it is, it's the start of a 5th wave. And here's this final 5th wave. Well, this date, I should have marked this in. This is the November starting point as observed on my daily chart. This is the 5th, and so we have another. This is the 5th. Everything from this chart, November, at the 150 area, this is actually not precise, but there are reasons for that. But this area right here, see the price level on the bonds, nominal price of the Treasury, about 150, starts a particular 5th wave. It's the 5th within the larger 5th that began back here at the bottom at the beginning of 2014. So this is 1 degree of embedding. I want you to observe that's an important concept. Why is it important? To the extent, here's the qualitative idea. The more 5th waves that you can locate and observe, and you see structure that are embedded or nested one within another, when they complete or when they finish, the more of them that are embedded one with another, the more likely it is the market will turn at the confluence, at the aggregate of all of these 5ths lining up and kind of nesting one within another. But more precisely, to put a quantitative criteria threshold on that, he said, when you get 5 of them, the market will turn. Anything more than that's probably even more than 97% probable. Less, it might turn nevertheless. Nowhere is it written that you couldn't have less. He just worked out statistically, you get 5 embeddings, 97% of the time, the market will turn. So that's the objective. That's why I'm going through this, what could be a little hairy, detailed analysis. This point on the chart right here in November, as you'll see on the daily, starts an internal 5th of the larger 5th that began here at the bottom in 2014. So that's okay, I wanted to just overlap. I should have, this is, okay, we're starting, this would be the 1 of a 5th. This might be the 1 right here, 2. All of this right up here, or here, wherever, 3, A, B, C, 4, and then the 5th of a 5th. Okay, and this is the bottom, the date, November of last year, 2015. So let's convey that overlap here. This is the same data point right here. This should be the end of that 4 and the start of a 5th. And so if that's the case, these are the little internals. This is November 9, which is the same data point right here. This is that end of the C, which is of the larger 4. If it's the end of a 4, it's the start of the 5th, which the daily chart now I'm drilling down to. Here is that same point. I could have labeled this the C, little c within a larger 4, and if it's a larger 4, it's the start of a 5th. I believe this is up here, the 5th, but these then are the internal 5 waves within that 5th. 1, 2, this is why I ended 3 because of the Fibonacci relationship. This little bottom the next day, that's atypical because forests, as I mentioned earlier, for those of you who are wondering, I said forests tend to take a lot of time. This is very odd in that respect. Nevertheless, it's not odd to the point where I can dismiss it. It's not overly atypical to the point where I can throw out my count. Okay, and then everything, this is another 5th wave. Okay, so that's why I chose that count. Again, primarily due to the closeness of that top to the corresponding theoretical fib relationship that thirds often bear relative to wave 1. All right. Now moving on. This is why, notice this, that count preserves another a similar but different attribute peculiar to the model. If I make this top here, this is the same chart, I just added my fifth wave, 4 and 5 counts for label or points on the chart. If this is wave 3 and this is bottom is wave 4, what do we know about fifths? Fifths tend to trace out 62 of 1 through 3. If you measure the distance from the bottom, November 9, through this top right here, I forgot that's somewhere, I forgot the date on that, but looking down here at the scale, the timeline, my horizontal dimension here, somewhere the first week or so of February, this month, just a couple of weeks ago probably, beginning of 2 weeks ago, that top is the end of 3. We had a one-day pullback. And then if that's right here, the smaller end of the fourth, the correction 4, it is the start of another fifth, a fifth within a fifth within a fifth. There, we're already at 3 levels of fifth waves, one embedded or nested one within another. Well, what is interesting about this? I'm not saying it's definitive, but it is something you want to pay attention to. If you measure the distance from this bottom here to the top, February 11, it is look how close, this is the ideal, theoretical, if you can see that Fibonacci ratio. If you measured this distance, I took my fib tool, if in the old days, 20-some, 30 years ago when I started, everything was on paper, you just do calculations. You take the difference in price between the top here on wave 3, the bottom on wave 1, you get a number, you take 62% of it, or 61.8 is your actual fib ratio. You add that 2.4, the start of ostensible point where you would believe the fourth wave has begun. And this is your theoretical. Notice how closely it comes. Is that definitive? Does that mean that the top over here at 170.15 or so must be the end of the fifth wave? No. But it is curious, you want to take note, the fact that by utilizing this count, making the wave 3 here, if I'd made this well, it wouldn't have mattered. But it would have changed the theoretical projection for where based on the Elliott principle and the internal fib ratios that the model specifies, it would have changed that. But given if you make this wave 3 and this bottom 4, it's the start of another particular fifth wave, a smaller degree fifth of the larger fifth, then curiously you come very close, within ticks of the actual theoretical. Is that enough evidence to tell me definitively, beyond a shadow of a doubt, to put a gun to my head and say that this is the end of a fifth? Certainly not, but it is curious. And again, when we couple that with alternate, very different pieces of information that similarly suggest a labeling for such, we begin to reflect on the possibility that it may be transcending a threshold of coincidence and might be more of importance. That's all. So this is a very close to a perfectly formed third. If you end the third wave here and allowing for a very close near to theoretical perfection for the fifth in terms of your internal Fibonacci ratios as observed on this particular degree of observation. All right, and this is just playing out this graphically. This is the bottom again, January 22nd. This is the top, February 11. I've utilized the Roman numeral to indicate that there is an embedding of a number of fifth waves. I've actually, you can't see it here, or if you can, but 1, 2, 3, 4. There are actually 5 levels of embeddings of fifth waves when we get up to this Roman numeral 5, and I would give that, that's going to give 40-50% weight overall to the person who asked the question, at what point and why or when did I become bearish to the bonds? Well, certainly to the extent I had observed the internal structure of the moves from going back in time, and once I had observed an accumulated embedding of at least 5 fifths embedded one with another, it says something. It does sway my view to interpret the price that the market achieved on Feb 11 as being of possibly great significance in terms of it marking the end of a particular fifth wave. So I believe that it is a point in price corresponding to at the high point, the fifth, it marks the end of a little fifth within a slightly larger fifth, within a still larger fifth, within a still larger fifth, within a still larger fifth. At least those are 5 fifth waves. And as such, then we've seen price action substantiating or in tune or that one might expect from that. thus far. Everything, the net trend since then has been down. Clearly, the last few sessions were going up, but you can see overall the net transition since that top on Feb 11 has been moving in a direction consistent with my projection thus far. And this just a little more clearly, here's a fifth wave right here. You can see this is down on a hourly chart. I took it down last night to 10 minutes, but again, just based on some technical logistical things, didn't have time to show that. But there's a little wave. This is a fifth wave here. Within a fifth wave, that's 2. Within a fifth wave, this line here represents from this bottom here. You can see here's a fifth wave within this fifth wave. That's 2 embeddings. Within this one that started right here, that's a third. Within this line right here that goes back to here, that's a fourth. Okay, and this one goes back much further in time. Okay, that's to the January, I think that was the January 22nd. This line right here is the largest degree that this chart is showing. It emanates from the bottom on January 15th. That's a particular fifth wave. That's actually the largest fifth that that this chart shows. And then within that, there should be 5 waves. Here's the 1, the 2, the 3, the 4, and so here's that fifth within. Or actually, here's the fifth within this. This line right here is 2, going in the opposite, going from the top down. From this line is a fifth within this line, ending up at the same exact ending point. And then that's 2 levels. This is a third. This bottom. This is everything from here to here is the fifth within this, which is in turn within this. That's 3. And then this bottom right here is a smaller internal fifth within this line, which in turn is a fifth within this fifth, beginning here, which in turn itself is a smaller degree fifth embedded within this line, which again started, I didn't scale the chart so that you could see, but this line, the largest fifth is observed on this screen, is illustrating the fifth that began on the bottom on January 22nd. And then it's hard to see, but this bottom right here, if you can see at the tip of my arrow, if you can see it, there is a little fifth. And it's very clear. Again, I didn't had some technical issues, so I would have liked to have shown you, let's say, on a 10 or 5-minute chart. But this is a little fifth that began on the very same day of February 11. It was down on the minutes level. This is a fifth. This is a line here within this fifth. That's 2, going from the bottom up. Smallest granularity of scale, micro to macro. In the opposite, a fifth. Within a fifth, that's 2. Within this larger fifth, that's 3. Within this, that's 4. Within this, that's a fifth. And these are 5. That's 5 levels of fifth. Don't even take into account the largest. There's another degree. There's actually 6 that I've identified so far. There could be smaller because I go down to, say, a 60-second or a tick chart. But suffice it to say, what I wanted to illustrate was that we have identified internal fifths at least very easily. There's price action for which clearly you can see. Observe it. You don't have to force it. You're not torturing the information, or the data is traced out on the screen. 5 levels of fizz, which by itself, it's not 100% certain, but it does give me 97% confidence that this top that came in on February 11 is of terminal point of interest. Is it guaranteed? No, 3% probability I'm wrong. But for my money, I'm going to take close consideration and take into account a 97% probable phenomena any day of the week. Okay. Now, is that sufficient for me to place a trade? It's compelling, but probably to the extent I have other very different but interesting but very different quality of information, I want to be further enticed into building and structuring a conclusive, I can't get enough information because it's all about probabilities. All right. By way of explanation, what are we seeing? This is just moving from, this is the argument, why are we seeing the price action we've seen in the last 3 days? We hit a bottom right around 164. Just from a practical standpoint, moving the progression of analysis and my chain of thoughts here for you folks, I sold it not at the top, but the next day. Based on technical factors. You notice, if you can see, this is an RSI. Notice the overbought here. When it crossed below the 70 threshold, and I'm mixing and matching different components of my analytical soup. For those of you who understand standard oscillator analysis, this is a standard generic tool. So when it crossed below 70, which is this line over here on a standard indicator, that was a sell signal in and of itself, and it correlated with this bar. And so I got shorted around I actually sold this initially earlier this week at 166, and then we went down to 164 a couple of days ago, and then we've been retracing ever since through yesterday's close. Why? How so? Why so? What is that? What do we make? What would one make, or should one make of this? Well, it could be a retracement. Markets 80% of the time. Oh, folks, I don't know how long. BJ, thank you. Lost audio. Someone's, how are we? Guys, can you hear me? Do you hear me? Do we have sound? Do we have sound? Lost audio. Ooh, that's not good. How about now? Audio, okay, I'm not sure. Can someone tell me? Yeah, at what point, how long, what slide? Yeah, but I know you were, well, hopefully you were following me visually. How long ago? What do I need to repeat, folks? The idea was embeddings. I'm not sure. Yeah, thanks for that. I don't, it's funny because I didn't touch anything, and yeah, the vagaries of technology. I have a friend who refers to computers as impeccable idiots. Technology and the conveniences that our computer infrastructure and hardware and software provide are phenomenal 80–90% of the time, but when there's the slightest quirk, oh, you know what breaks loose. Yeah, I thank you for the feedback, VJ and company and everyone who's given me that. To what extent did you, I appreciate it currently. How long ago, can someone just tell me about how long did you not have the audio? Okay, good. Thank you, Bray or Bra. Earl, never lost audio. Okay, thank you. Okay, all right. Wanted to give, all right, so what I'm saying here is I sold this earlier this week at 166 even. That's the nominal price of the 30-year Treasury bond. And by the way, just footnote here, folks, I'm talking in very broad general terms. You got to be careful. There are many ways up the mountain, in a sense, strategically. Trader with X amount, what the specific strategy you as an investor, speculator, market operator should employ and use will be taken into account if we're doing this correctly, the process of investing and trading based on equity, based on your tolerances for risk and so forth. So I sold the contracts. Another investor on the equity side may trade an ETF like TLT or TBT. Another trader may do an option strategy. The specificity of approach and strategy should necessarily, in my estimation, given everything I am aware of in 34 years of this business, reflect, again, your level of equity, what your tolerances for risk are, what your protocols for risk thresholds, what your emotional tolerances are, the proclivities of style. Are you an options trader? Are you a direct trader? Are you an equities trader? If so, and how so? There are many ways to do this. I could have sold call premium. I could do a call spread. Essentially, what I want to convey, and in the context of an hour or so, and I'm looking at my watch, I see I've gone over, so I'm going to wrap this up shortly, but I just want to convey primarily the thrust. I am bearish the market, and the specificity of strategy and what can vary. You put 10 traders in a room, you may have 30 different approaches that are plausible and viable depending on how and what specifics distinguish one trader and investor from another. So that's a separate webinar unto itself. But primarily the focus of today is to convey a sense of my projections in terms of interest rates, the economy, and a viable direct play, specifically in the bond market as it relates to this. All right, so I think, the point I'm making here is we've taken back, I'm actually a little behind right now. I think we closed yesterday in the 30-year, in the March contract at 166.19, thereabouts. Some of them 19 ticks out, but this is typical. I would love to have said, now, some traders may have taken, those who I work with and consult and I teach and mentor, some of the people that get the signal and traders who follow what I do may have, have different time horizons. If you're a short-term trader, long-term trader, swing trader, and there continue, nuances of degrees of time horizon. You may be very short-term, trading intraday, and even within that. So, there's always principles and protocols of good capital allocation behavior. When do you take profits and what partial profits and pyramiding and all these things beyond the scope of today's presentation, primarily just to convey a broad sense of my view concerning the interest rate and debt market, in particular in bonds, and is the instrument I'm choosing. But here is to say we have a degree of retracement, which is fairly typical. Again, 80% or so of the time, markets do not trend in a straight line, but back and forth. 10 steps down, 4 steps back up. 3.5 steps down, 1 and 3/4 steps back up, creating step-like structure. Sometimes it's perfectly symmetrical, or more often it's asymmetrical. But I put in these two Fibonacci levels, 61.8, 78 to 6, to suggest or surmise the possibility of a Gartley, for those of you who are familiar with that degree of retracement. That's a different idea. It's a special case of Fibonacci retracement analysis. So it's possible that you can see here, to show you where that intersects, the Gartley would get you up into this area about just over 168. The range between, we've got overhead resistance there, what is that? 168 to 169. 168.08 is the lower fib level, the 61.8 up to the 78.6, 169.12 area. So it's quite possible we might retrace there, or not. We don't know. The 50% is somewhat important, but that, I believe, is what's responsible as a descriptive possible comment on why the market's doing from a technical standpoint. The reason the market's doing this might have more to do. We got a strong report yesterday on what is it? That consumer spending was up yesterday. Stronger job market. I think the CPI came out and showing 2.2%. So I always, vis-a-vis my attempt to integrate what's going on in the real world, event-wise, that is what we call fundamentals, relative to my technical. And that's where you get the best of all worlds. I had a coworker years ago, a good friend of mine, who said, to make a point, a theoretical point, or a philosophical one, that is, what's the sound of one hand clapping? The idea he was trying to impress upon us is this, the best of all views, typically, we can assume will have a stronger footing on all fronts to the extent you can support it with a shotgun approach. We want to have a few different, very different ideas that, in spite of their differences, are moving closer and closer into alignment. It doesn't happen all the time. When it does, you can typically establish that you should have greater confidence in a multi-pronged view that is standing on not just a single theoretical premise. All right. So clearly, now, if you're in it and you're short, and these levels could establish zones of resistance above which you might again, taking into account getting out points and so forth. But I just wanted to, as a possible explanation, we're doing what could be a normal retracement, and then we want to factor that in with the strength of news that came out yesterday. We've got an interesting week news-wise coming up. I think a number of the Fed governors are scheduled to speak. I think at the end of the week, next Friday, we've got PMI, personal manufacturing index or something. We've got personal consumption, I think, also next Friday. But a particular note for those of you who are following fundamentals, and I'm not oblivious. I just don't start there, because trying to ferret out, especially the equivocation with which the Fed issues proclamations is gut-wrenching, to say the least, and that's being optimistic. But I think I will just wrap this up or synopsize my take on the current state of affairs, given the information that came out yesterday. Is what I can imagine. I think I read a report last night that prior to the strong CPI indicating a growth of about 2.2 relative to the Fed's target of about 2% of inflation, that from from the rate hike that occurred in December, that many analysts were projecting that there would be about a 25% probability of an additional rate hike by the end of 2016. We have, with the given data that just coming out yesterday, we've kind of raised that to about 40% likely the Fed will have at least an additional rate hike. Whether or not that's the correct monetary policy, that's a separate issue. But we're getting some evidence progressively to indicate a stronger job market, increasing consumer spending. So that would suggest an increase. Again, the probabilities went up as recently as yesterday with the output of the data we are seeing, and assuming we have some follow-through, the tendency of probability has risen from about 25 to 40%. We could see this. Why is that important? Because there's a tendency from just a very cause and effect standpoint. There's the inverse relationship. When rates rise, nominal bond prices tend to drop. All factors isolate, all other variables isolated. So that would be another, even the actual raising or adjustment of rates and or the perception of the oncoming event can move markets. Remember, we're dealing with financial markets where perceptions are 80% often. This is what imbues and introduces some of the intrinsic high levels of complexity and the feedback loops that we see in financial market flow. But again, taken at its worth, there is some stronger than a month or two ago indication to expect further policy of hawkish interest monetary maneuvers, and as such that would tend to put pressure on nominal bond prices. So we've got a fundamental component that is looking like it's moving more directly into alignment with some of the technicals that I'm looking, further strengthening my bearish view here. All right, we've got to that extent, one could say in a broad scope that the policy, now we'd never know. This changes moment by moment, day by day. Janet Yellen can come out one day and then a month later make the diametrically opposed statement. So, but you take it given the information you have and try and combine the components that you feel are disparate but trustworthy and look and see where patterns of alignment are present. And okay, yeah. I was going to say, to wrap that up, I would simply say that it appears that the grand, bank experiment with quantitative easing and it looks like we're leaving that behind, and it further it looks like it's getting further and further distant in our rearview mirror. And as such, that I would expect would put additional or be a component that would serve a bearish view in the bond trade well. Okay. All right. Let's see. Moving on here, folks, and we're gonna. All right, so that's my. Okay, this is COT. This is the daily chart. I showed this on the monthly and the weekly. It was very clearly. Notice the red trending. They went back middle of November 2015 from strongly maximum. They were up near 40,000 net long positions to where they are. This is what you want to see. That's the primary focus of the Commitment of Traders report chart. This is the red line clearly went from net long. Notice the inverse relationship between price activity, the trend in the bonds, versus or relative to the trend in the positioning, the net positioning on the part of the commercials. And as is very typical. And then the next step in the rationale is, what are they doing? Well, they're at their most extreme net short. They're more, more than greater than 20,000 net short positions, and more. What exacerbates and it makes this of greater significance is the fact. Now, there is an interesting, just in the last, so this report comes out weekly, every Friday. The government, CFTC, indicates it's an accounting. This blue line is the small traders, so it's now the green line to be a little just changed in yesterday's report, so it's almost in sync. But the polar mirror image character between the blue line, the small traders, relative to the or the red, the commercials, is what's of significance, and that's why I really wanted to highlight this for you. You can clearly see this on this screen, on this slide, and that's a very important point, further strengthening my bearish view. And it's existing on the going back for 25 years, for 5 years as observed on the weekly chart, and here just this is a 6-month look back as observed more as a drill down in time. We're seeing this pattern of commercial increasing going from a net long to a net short, and simultaneously the corresponding opposite behavior, same more or less similar value quantitatively, but opposite sign in terms of net long position. When that occurs, because that's very odd, as I said, it meant earlier, it occurs less than 20%, usually 15% of the time, and that because they tend to be wrong, it further strengthens whatever it is in trending on the part of the commercial. So that's ostensibly bearish as well. So we've got a confluence of different things, any one of which may be wrong, all of which could still be wrong, but less likely so, and therefore by default, in looking at the statistics, it seems like that is some case to embrace the short side of the nominal bond price. And it also indirectly can give us a view on the course of interest rates or the interest rate curve. Right now it's more normal, depending on one's view in terms of inflation, recession. I don't see, but we are, the 30-year now is at 2.2, so we shall see. So let's see here. This is just an additional, for those of you just who like, this is kind of rudimentary, but just so you can see. Okay, someone's asking, based on my bond presentation, what is my take for general stock market near term and future and the rest? Well, let me answer the latter part of your question first. I'm bearish on the market by the end of the year. I expect stocks, just again, I'm time constraints here, but the stock market, I believe 95% confident will move up into March 2nd. Very specific, very specific. My area of research is market timing, vis-a-vis what I mentioned the earlier slide, the slide at the beginning of the presentation. 3/2 is a critical date, in the same way that for those of you who tuned in and were the last presentation, I knew 95, 97% probable, and I call that for my, good for government workers, knowing that last month, January 12, 13, was a 2-day window. I knew the market would top in a almost as strong. I have one cycle that's not present corresponding to March 2nd. 3/2. 3/2 is the date. So overall, based on the price action we've seen the last few sessions, I expect broader stock indices. I follow the S&P, E-mini, ES, but overall the trend, I'm not saying it's going to go straight up, but between now and the first week of March, expect price equities to rise. At which point, change. I don't know for certain it's going to be a top. If you ask me at this moment, I expect that. But other types of change than the most obvious 180-degree shift of course, an outright trend reversal. There are other changes, but I do know something similar to what I expected, and we nailed it because I sold it January 13, and 7 days later, just based on the confluence of cyclical components that enable me to project my time points, having nothing to do with price. So I'm shifting gears here in response to the question. So end of 2016, I expect stock market will be considerably lower. I haven't worked out the price targets yet. Easy to do. I just haven't done it because we're just getting started into the first quarter. But I do expect shorter term, what do I mean right now, the market to go up between now and the end of into the first week of March. So today is the 20th, so we're talking basically a week and a half or so to 2 weeks, possibly plus or minus a day or so. So stocks in the near term will be rising. And then longer term, can't say exactly, I haven't worked out the rotations. I will in the next weeks and months to come in future presentations. I'll give you more explicit detail as we approach those important critical time points and more that I utilize as kind of guideposts, if you will, in combining it with the price stuff and analysis. But what's of critical importance, and analytically, I didn't focus on it or emphasize it, but I start with my timing and then attempt to fit in the price dynamics in a manner that would be dovetailing and reconciling with my rotational time targets, if I have confidence in them. And I do for 3/2. Curiously, I just worked out just in the last few sessions for the interest rates for bonds, my next important time target, not surprisingly, the day before, March 1st. That's not coincidental at all. It's that they're highly correlated. But 3/1 and 3/2, March 1st, March 2nd, for all practical intents, is one and the same data point. That's a reasonable window of time within which, from a capital flow standpoint, from a fundamental standpoint, from a technical standpoint, they're basically the same data point. So I'm not surprised. That's the type of convergence or nexus I'm looking for. I couldn't have forced it, but I just, based on a confluence of factors, I'm coming up with 3-1 for the bonds, 3-2 for the stocks. One and the same date. Not so, makes perfect sense to me. All right, so for the near term, you know, if you're, depending on your time horizon, you like to have positions in play in the market, I expect between now overall and the first week of March, rising equity environment in the U.S. at least. After that, I'm not certain. Again, probably looking for a top. How significant, I'm not certain, but that's the nearer term. And by the end, I do expect 2000, the fifth year of every decennial tends to be what Gann called, and people like him, Jansen, Robert Krauss, Wyckoff, etc., years of ascension. You go back for the last 150 years, every decade, every 10-year, every decade, the fifth year, statistically, I forgot, I think it's like 87% of the time, fifth year stock markets rise in the United States. So that's why I knew that the overall, I was expecting appreciation for the stock market last year. 16, not so much. The sixth year of every decade tends to be destructive, problematic. That's another story. Anyway, purchasing manager, yeah, that's purchasing manager. I think that comes out Friday. The slide shows positive correlation between bonds and stocks. Yeah, sometimes but they're leading. It's a leading. Usually, what the bond market, the bond sector leads the equities. Usually, typically, and there's a phase difference. Someone's asking about, will election years tend to be bullish? Yeah, you got to. That's another factor that this is why there's so many. You know, where you start. To your point, yeah, I totally agree. Brad or G or whoever is making, yes, Brad. To your point, completely, yeah, I totally agree. I'm being a little simplistic because I don't have time to elaborate on each one of any one of these relationships. We can spend an hour on, but yes, to your point, yes, and we are in an election year, so I got to take that into account. All right, let's see. This is okay. Run times. This is the date I just referred to. This yellow line, if you can see it. I just worked that out in the last few days. So that just not because I could have done that based, well, no, in this case, I did this utilizing a number of different tools and models, and I'm not going in, this is not a program based on how I do my time projections. I've been doing this in this, it constitutes the thrust of most of my analysis. And utilize a lot of ideas that people like Gann came up with and worked with cycles of all sorts, price cycles, terrestrial cycles, planetary cycles, numerical cycles, volatility cycles, mathematical relationships, price configurations. What people like Gann realized was the equivalency of price and time. That's another webinar. But in any case, suffice it to say, a date, a point in time for which I have a lot of hits is for the specific to the bonds is 3-1, which curiously I don't have a chart for the stock market, but this market I have 95% confidence. I feel comfortable in saying March 2nd. So they are essentially, you know, they're 2 different days, but they are, for my purpose, you know, from a position standpoint of evaluation. If I'm a day trader, it's irrelevant. You know, it's too insensitive. But from a swing trading standpoint or a position trading standpoint, 3-1, 3-2. What days are they? Let me look at the calendar. March 1st is a Tuesday. March 2nd is a Wednesday. Just look at the calendar. So they're one in the same. If I'm a position trader, certainly if you're a day trader, it's not sensitive enough. But depending on your time horizon. But from the standpoint of the more macro view and a position trade that one could anticipate and put on and put in and establish, these are my important dates. Now, going further out. For the bonds, I've already worked out April 18. I don't know at this juncture whether that will correspond to a top or a bottom, but I do have a high expectation for some type of change on or around 418. But more to the point, more proximal to where we are currently. So it's conceivable. I don't know for certain that the market will continue to move up into that, but it's a possibility, or maybe not. But you know, and from a analytical standpoint, if this is the end of a fifth, this could be your A, the move up could be a B. I would expect a C to bring about another move. Or it's possible that this could be the end of the bull market entirely and the start of a new bear 1, in which case this would be a correction 2. So there are a number of plausible scenarios that are consistent with, say, for example, the Elliott principle that reconcile with my projected time points. And this is always, in principle, what an analyst, one way or the other, might be attempting to do. What differentiates and distinguishes one analytical approach versus another, one trader, one analyst might find value in, one type of analysis, maybe pivot point analysis. Another would focus more on candle structure. Another would be Ichimoku. Another would be seasonality. Another would be studying interest rate policy from the Fed or monetary big, central bank maneuvers. Another trader might focus on oscillators. Another trader might look at volume price correlations, etc. There's an infinite possible amount of permutations of relationships and models that one can employ. The idea is critical, again, to focus on less in the universe of analytical tool set that you're applying. Make sure that you have enough of a differentiation of soup of tools, and then look and see when those very different things tend to converge, and that will serve to bolster your the confidence you can have in whatever correlations are presenting and you're deriving. All right. So these are specific. This is the next one for the bonds, and just bear in mind, folks, I don't have a screen. I should have, for juxtaposition and comparison, my date for the stock sector, the S&P, but that would geometrically apply to whether you're trading the Dow, the Spiders, NASDAQ, etc. There are some differences, but more or less based on my timing, they are germane to any and all of the above U.S. indices. Let's see. March 2nd for the stocks 3-1. So that's of curious because you can expect on different levels capital flows would be intercorrelated as well. Certainly, I'm not surprised there. Folks, it's been wonderful. We're at conclusion. If you'd like to learn more detail about some of the programs that we offer at Pacific Trading Academy, you see our contact information on the screen. Peter Newman is the person that handles the details contractually and can give you a little more insight in terms of the broader scope of programs we offer as an academy. But if you'd like to know about any of my research in more detail and how I do what I do, as well as, again, from time to time, I don't know how my student list is now. If I seem like I have some time, but I don't know. But he handles all of this, and I don't handle any of that. You can access our website, myself and some of my co-mentors. We all have different approaches. I focus on technical, timing in particular, and here's the contact information, 800-339-8588. Again, the website, Pacific Trading Academy, www.pacifictradingacademy.com. And then if you like further contact with me, you would do so, utilize Peter Newman. He heads all of this, and possibly, from time to time, he has me talk to prospective students and people who would be interested in some of the programs. As I mentioned at the outset, we have recorded today's presentation. If you'd like to review it, you'd contact us, and they can tell you the procedures to do so. But again, feel free to, there's no price or anything, no obligation to, but you can check out our website if you have interest. Let's see if there's any other questions or any comments. Does leap year have any correlation? That's it. I don't know. I was born 10 minutes before leap year, on a leap year, 10 minutes to 12. So I don't know, but I was there some years ago. I was born. Were it not for that 10 minutes, literally, I was born 10 minutes before a leap year. So this time next week, I will be celebrating my. It might. Good question. You got me, Vijay and Sheth. I'm going to reserve comment because I just don't know. It might. I don't. If you're not being if you're being serious and not facetious, I just don't know. I would tend to think that any and all, because now some people think I'm completely off base, but I believe that a lot of phenomena here on Earth, are ultimately serve as catalysts and triggers and drivers for market behavior, and a lot of phenomena working backwards. I believe that planetary and or astronomical phenomena in turn influence and impact and inform terrestrial behavior, which in turn impacts and affects and alters and influences human activity, which in turn is reflected and shows up in financial market behavior. So it would be reasonable to assume, but I don't have any specific objective data to support. I just don't know to what extent a leap year has on the broader financial market behavior, or much less a specific market. I would have to look into it. If you're serious, I will, just for my own curiosity, I will follow that through so that in a future presentation I will have some insight in case you ask me, or I can address that, because I just don't know. That's something I've never considered. My gut and instinct suggest there may be, but the specific, if there in fact is, if my intuition on that serves me well, I don't know the specifics and details and as to how so it might. But I will check on that, and so in the future I may comment, and if I don't, bring it up, and I assure you I will, share whatever I can find out about that. Thank you for that question. I just don't know at the moment, but I'll look into it. Yeah, could I please let me know the Fibonacci ratio relation from third wave to fifth? Well, RAGX, or whoever's asking, or VJ, again, the two relations that I focused on to support my particular description or count, one was specific to generating a projection of tendency peculiar to fifth waves, the other for third. If you're I want to make sure I understand the question. If you're asking me, is there a spread, a typical or a general spread tendency relationship between the end of wave 3 and the end of wave 5, I could figure that out. I don't know. What I had mentioned earlier is there are many others. Like, for example, often 80% of the time fourth waves don't exhibit or move in a manner consistent to generate a degree of retracement of the preceding third exceeding 38.2%. 80% of the time. That doesn't mean you can't. And that relates to the other point when someone else at the beginning of today's mentioned or saw that, felt that I had encroached on a rule of the model. And it was, yes, again, to reiterate, that was an original rule of Elliott, that you cannot, that no part of wave 4 should ever enter into any portion of wave 1, or the end of the fourth should not encroach on the end of the first. And relative more quantitatively to that, just as to give added nuance of context of interpretation, fourth waves typically do not retrace the preceding third. When I say typically, rarely, and when I say rarely, less than 20, no more than 20% of the time will you have a fourth that exceeds 38.2% retracement of the prior wave 3. That doesn't mean it can't. It can. I even believe it can go as far as it wants, given the more recent research in the last 30 years in particular. And again, I would reference Hennessy's research in particular to support my interpretation or take on that. But your question is, if you're asking me what the relationships are, I'm not quite sure I understand the question. Are you asking me to just repeat what I reemphasize and go over what I said? Well, if you're talking about, and I'm not sure, it doesn't sound like that's what you're asking. I think you're asking me, is there a specified relationship indicating the typical spread of distance between the end of wave 3 and the end of the wave 5? If there is, I've probably forgotten it. I just don't recall off the top of my head. What I mentioned earlier is, in order to project theoretically, a standard mode of deriving a projection for the end of a fifth is you measure 1 through 3, you get your distance. Your travel of distance between the start of wave 1, the end of wave 3, often fifth waves will tend to move. It's not an absolute rule or certainty, but it's a tendency of structural formation peculiar to fifth waves. They tend to trace out about 61.8% the distance the market has moved from the start of the first to the end of the third. But especially when it pertains to fifth waves, there is this hyper tendency, greater than, say, 70% of the time, for what Elliott referred to as fifth wave truncation, where they tend to be runted or shunt or shorter than typical. So you want to contextualize whatever calculations you generate for a fifth wave with that broader, put it in that broader context. Sometimes on the continuum of possible degrees of truncation for fifth waves, they are so short that the end of the fifth does not even take out the end of the prior third. Not ideal, but it doesn't by itself break any of the three original principles that Elliott came up with. So whether or not you would maintain or hold on to that particular count versus an alternate is you have to put it in the context. We don't want to throw out the baby with the bathwater, so to speak. To the extent alternate portions of your description, your count, are viable and serve to generate valuable information in the scheme of things relative to that flaw of a shorter or less than perfectly formed fifth, would be that would be the framework within which I would determine whether or not I should keep a count that has a severely truncated fifth or not. Okay. The other calculation that I indicated, now again, I'm not sure if you're asking me how to calculate thirds and fifths. Third waves, typically very simple. They typically, are going to trace out a degree or extend out a distance more in the ballpark of about a 1.618. 1.618, the golden ratio, the magnitude of your corresponding first wave. Any and all, for all of these waves, each waves have Fibonacci relationships obviously attached to them that generate their typical peculiar properties. Thirds tend to be the largest, the fastest, the longest. They don't have to be. Remember, the rule does not say that the third has to be longest. It says it cannot be the shortest. Very issue. They off 70% or so of the time they are the longest, the most powerful, the highest velocity is reflected on a two-dimensional surface like our screen as the steepest slope, the most explosive, etc. In Elliott's own, I always tell the student traders that I teach Elliott to, tell him in his original papers, Elliott said, quote, "Third waves are wonders to behold," end quote. But they don't have to be. They often are. You can have a third that it falls short of your 1.618 extension, is a perfect congruent hit, or exceeds it. I would say about 70% of the time, thirds in the real world, any market on any scale or time period or degree of observation will typically exceed your 1.618 extension. But that's textbook. Not sure if that's what you're asking me. If you're asking me something different, which the only other way as I'm interpreting the question, if you're asking me about the distance typical between the end of 3 and the end of 5, it's lost on me at the moment. I'd have to check and go back and review because I'm just not aware immediately in my thinking as to a relationship specific to that spread, that portion of the cycle. But good question. If, on the other hand, you were asking me to just reiterate and reemphasize how you do the calculations for projecting a third and a fifth, there you have it. Okay. Brad's asking, will negative interest rates, vis-a-vis Japan, Europe, etc., Mario Draghi continuing in Japan and Asia, so, bank yields and bank stocks in Japan are going up because of low, interest rates and so forth, but will negative interest rates be good for the bond market? Ostensibly, again, yeah, in a vacuum, yes, all things being equal. To the extent we start raising rates, just fundamentally, folks, just I don't know if I said this in general, the way you begin to think about in a very facile and simplistic way, but nevertheless somewhat relevant, good news, just what is generally agreed as a consensus view to be acceptable by all of us in a consensus, if there is such a thing, and I know the consensus changes over time, but to the extent we get good news, that's bad for bonds, the nominal bonds. And vice versa. If things are negative and is generally, obviously in an immediate, obvious, consensual way interpreted to be bad, that's good for the bonds. Why? Because of the corresponding response on the part of the bank, the cabal, or whatever. I don't want to get into that, but the central bank. Monetary policy responds to and it creates, and there's a feedback, but more or less that's how I begin to think about what the bond market is going to, or interest rates or a debt instrument will do. In general, when I hear bad things, when more people, if consumer spending drops, if the job market tends to weaken, we can expect that the Fed is going to be conciliatory and tend to shift to be more adopt a more dovish policy, and vice versa. When things tend to heat up, we're seeing signs of indications of strength in the jobs, consumer spending, confidence, etc. All these things, which is good news. That tends to be bad for the bonds, because the bonds then attempt to put the brakes on the cost of money. So will negative interest rates, yeah, so again, yeah, that would be good for the bond market, yes. Oh, thank you. It's actually next Sunday. Thank you, I assume Steven, so, or STE, whoever. Okay, I lost your contact. Who is this? Tom? I will, let me write this down, because sometimes you may have previously, and I get so busy. I remember you, Tom. Thanks for attending. I have your file, or I can contact the office to get your number. I will, yeah, thank you. Thanks for showing up. I hope to some extent, I didn't get into the specifics. It just, a presentation such as this does not facilitate specifics of entry and so forth and how to do it, and depending, because you take into account the specifics that define your account. Suffice it to say, I'm bearish to bonds, and I expect it's on the order of weeks to months. I've told people who are doing option plays to, buy premium puts or put play or whatever strategy would embrace projecting lower bond prices, to go out, at least 60 days, just so you get some detail here. Let's see, someone's asking, how can I contact you? I would give you my number, but I don't want to give it out all in a public sense. So I can assure you, Tom, I will get back to you. If I cannot find your file, I will call the office. So, and they have your file. Okay. Go to the next. Someone's asking. Then you read from the top down. Go to the next column. Thank you. Not quite sure this. Then read. Oh, wait a minute. Let's see, someone's asking, so read the slide with and then it's nothing. Then it says, I read from the top down, go to the next column. Thank you. Not sure. Findings later. I don't know, folks, but I don't quite get the last question. Someone's asking, reading from the top down. The only thing I can think of is I was earlier in the presentation indicating I was demonstrating price action in segments of a chart to illustrate the evidence of price in the bond structure as you drill down the internal fifth waves. And that is why that's important. I don't want it to seem like I was making much ado about nothing. To the extent you can find, the more fifth waves that are embedded one within another, the more probable that the largest degree of fifth wave, which also is the meeting point, the place of coming together, of convening for all of the internal fifths, that when you get 5 of them together, statistically we find that 97% of the time that will correspond to a terminus, a turning point in price. And so it goes a long way towards for giving us and providing the confidence sufficient to ensure on a continuum of odds that you have correctly identified a reversal point. So that can give us some edge. Trading analytically is all about utilizing in your tools of analysis to acquire as much edge. When you believe you have a value area implicit with edge, you then you go into your money management and your strategy, but that's the starting point, to locate mispricings where based on analysis you feel you have a degree of and an amount magnitude of edge quantitatively in excess of your counterparts, so that you can improve your odds for financial return. That's the point. I'm not certain, because I'm missing some of the question. If that's what you were referring to, the top-down approach was specifically referring to illustrating a little more explicitly the levels of embeddings of fifth waves, all for leading up to the top that came in on February 11 to indicate, I believe it is a fifth of a fifth of a fifth of a fifth, at least 5 fifth waves embedded. And as such, in part, and I give a lot of weight to that, 40 to 50% as to why I believe the top that came in on 211 is a significant top. And is it the sole reason why I'm short? No, but we had the other evidence. We had the fundamentals, we had the COT, the wave pattern, and in particular that aspect of the wave pattern, the degree of fifth waves that I pointed out, and my timing point, the run time that I expect. Minimally, I've got my time targets as we mentioned. 3-1 is the first time point that we see here, and then the next one I worked out to come further out into the future. April 3-1 is the next one most immediately. Interestingly enough, it correlates just the next day is the corresponding turning point for stocks. So that I find additionally important and taken into account. And then later, further out, is April 18th. Folks, I've got to wrap it up. Again, I appreciate your questions and great set of questions here. And again, to the extent you'd like more details, you can do so. You have the contact information. Thanks again. Proctor had mentioned about Fibonacci. Yes, yeah, it's a classic, his book. I highly recommend it for those of you who want more details on Elliott. Okay, excellent, guys. Okay, I wish you, until next time, hopefully in the next few weeks or months, I'll do another presentation as the events unfold in our economy. And until such time, I wish you great success in your trading. Have a great weekend and profitable trading in the weeks and months and years to come. Until then, have a great day.